What if I told you that paying thousands to get a lower rate often doesn't save you any money? In fact, in most cases, it ends up costing you more. And yet borrowers do this every single day because no one shows them a simple calculation you can use to determine if it actually makes sense. And today, I'm gonna show you how to know if buying the rate down is a smart move or a trap. Let's dive in. I'm Aaron Klaus with New Way Mortgage, and after helping thousands of clients analyze loan options over the last couple of decades, I can tell you this. Most borrowers are often sold the lowest rate, when in fact, they should be shopping for the best financial outcome. Big difference, and today I'm gonna show you why. Hey, and before I dive in, if you like no BS mortgage advice, make sure to destroy that like button, hit the subscribe. So let's start with the basics. What are points? A point is simply prepaid interest. 1 point equals 1% of your loan amount. So if your loan amount's $500,000, 1 point equals $5,000 in fees. And in exchange, the lender may offer you a slightly lower interest rate than what you'd get otherwise. Sounds great, right? It does until you ask the question that most people fail to ask. How long does it take to earn that money back? I like to call this the break-even test. So for the break-even test, you're gonna wanna use this formula here, and it's really simple. You don't need a degree in calculus. This is simple stuff. What you're specifically looking for is how many months will it take for you to break even, meaning that you've saved as much money as you spent to get the lower rate. So for my example that I gave before, where the loan amount's $500,000 and you have 1 point, so it's $5,000, and let's just say that the additional savings is $100 per month, all you're gonna do is take 5,000, divide it by 100, and that's gonna give you 50. So it would take you 50 months to break even, which is a little over 4 years. So it would take 4 years to break even in that scenario, which means that you would have to keep that loan for at least 50 months, so a little over 4 years, before you've actually saved a penny. Because remember, you're paying that money up front to get the lower interest rate, to get the additional savings. And if you have that loan for any less than the 50 months, you've lost money. Now here's where most people get burned when they buy down the interest rate. Most homeowners, they simply don't have the loan long enough to get to the break-even point. Why? Well, it's simple. They either refinance when rates come down, or to pull equity out of their house to do home improvements or consolidate debt, or they sell and buy another house. And then all the money that they paid extra to get the extra savings is gone because they didn't actually have the loan long enough to recoup the costs. So basically you prepaid interest that you never fully recovered. And that's not saving you any money, that's just an expensive bet that didn't go your way. So why do a lot of people do this when mathematically it usually doesn't pencil? It's not that they're dumb, it's just that people have been conditioned, they've been taught to think that a lower rate equals the better loan. And that's just not always true. Often the better deal is a slightly higher rate, or a 0-point deal, or maybe even a loan where the lender gives you a credit instead of charging points. And why is that? Because preserving cash often outperforms buying the rate down, especially if you might refinance later, or if this isn't your forever home. In that case, mathematically, the lower rate is worse. Just let that sink in. Okay, let's talk about when points do make sense. Because to be fair, there are times where paying points is the better move. For example, if you know that you're going to keep this loan for a long time, or if the break-even period is really short, like maybe it's only a year or 2 years, something like that, or if the seller is paying for the fees, not you, or if the payment reduction is necessary in order to get your debt-to-income ratio low enough for you to be able to qualify. In those scenarios, buying the rate down probably makes sense, but you still have to do the math and weigh out your options. Here's what I like to do when providing quotes for clients. Instead of just just giving them one option. I like to show them 3 options. One option with no points, another option with a little bit of a buy down, and then a third option with a heavy buy down. Because ultimately it's not my loan, it's your loan. So I need to give you the information you need to make an educated decision. But most of the time what you will see is that the more expensive loan usually doesn't make the most financial sense. Most of the time the break-even period's like 5, 7, 9 years, something like that. The odds of you having that loan for that long are very low. And that's just not a good use of your money. So before you pay points, what you need to do is ask your lender, what is the exact cost? What is the monthly savings? How many months does it take to break even on that cost? What are the odds that you're gonna refinance within that time period? And what does a no point option look like? And if they can't answer those questions for you, that's a problem. So remember, don't shop for the lowest rate. Shop for the options that put the most money in your pocket. And sometimes that means paying points. But like I've said, often that's not gonna be the case. And if you found this helpful, hit subscribe, because I break down stuff that the mortgage industry rarely clearly explains. And if you want help comparing point options on your loan, go to meetnewwaymortgage.com to schedule a free, no-hassle consultation, or feel free to call or text me. And if you're getting quotes right now that have points, drop points in the comments, and I may do a follow-up analyzing real loan scenarios so that you can do a deeper dive. See you on the next video.